So guys, the main motto behind this webinar is to make all of us aware about the basic jargons of the fundamental analysis so that you yourself can analyze and understand the fundamentals of the company while making investment decision. Because we believe stock market is a very profitable investment only if you know what you're doing. Otherwise, it's just a giant casino where you can lose a fortune. So guys, I think it's better to learn more about stock before we invest in them. Moving ahead, the main motto is also to understand why we invest in stock as an investment class and not in other asset classes. The main reason would be to outperform the bank deposits and beat inflations. And one should also keep in mind stock also comes with a risk involved in it. So today we will just try to measure some risk and understand some important concepts so it can help us making a investment decision. And in today's world, I think most of the investors are relying on gossips or tips to make some quick money, but I think that's really not a good sign. This can be a very risky gamble at time. So I think apart from tips and gossip, there are far much more better ways one can start investing and using them as a concept like fundamental or technical analysis. Before I start with today's webinar, so it's just a index what topics we're gonna cover today. We're gonna start with just a brief description about the types of analysis and what are the data inputs we require in different types of analysis. Then further moving how the stock can be classified and then an initial process of a stock selection. It can be top down or bottom approach. Then moving down to the industry structure, how we should able to find out whether the industry is attractive in the long run. What are the things we have to look out from the industry? Then finally, once we have completed the macro things, we'll slowly move into the understanding of the business. Then finally, the most important thing in fundamental analysis like financial statements, then further ratios, valuation, understanding dividend concepts, and finally the most important topic which I think today is called understanding the quality of financial reporting. Well, just to give you a brief description what fundamental analysis tries to tell us, it's tries to determine the value of a stock by assessing its assets and future income, which includes taking things like into consideration like financial results, annual report, disclosure, management guidance, etc. We always use a word called intrinsic value while we use the word fundamental analysis. What it means, the true value of a stock by someone who understands the company and a stock very well. And it's really not necessary that the market will have one intrinsic value because as we all know there are many brokerage houses, so it's really not necessary that every brokerage house will have one view on the stock. Different analysts and different investors have different kind of view on the stock. On talking about technical analysis, it just tries to predict the price movement by taking the price which have occurred in the past and also the volumes. Moving on, here are the data which we require in fundamental analysis. If we are going with a macroeconomic data first, we have to take things into consideration like GDP, IIP, inflation, monetary policy, then financial results like quarterly result of the company, then annual report which tries to tell us the history of the company, any corporate announcement which the company has made which will affect the company, then management guidance. The management tries to tell us the upcoming year how it will be and what things will impact the company's earning. And last would be we should be keep ourselves updated by reading the newspapers and the various new research reports which is issued by the various brokerage houses. And on the technical side, the data only which we require is just the price chart and volume. Well, as an investor, we can always, not always, we can sometimes classify the investment decision based on the risk appetite of the investor. Like one investor who doesn't want to take much risk while investing, he would invest into a defensive stock. Defensive stock is something like which tends to be stable when difficult economic situation. The best example would be FMCG and pharma. Like if the economy goes into a downturn, like people would really won't stop eating medicine. Yes, it will affect them, but not much like other risky business will do. And other side, talking about cyclical stock, which is highly dependent on the economic conditions and many other things, like the how the economic is panning out, like how would be the capex be funded, government policies, etc. I think infra in reality are the best example if one has to invest in the cyclical stocks. Moving on to understanding the investment approaches, like if you want to, how we should start selecting a stock. I mean, what would be the initial step? From where should we start our research? Like it could be a top-down approach or a bottom approach. Talking about the top-down approach, we try to start first taking things into macro perspective. Like if we think the global scenario is very good for investment, then we select a particular country which could be a best outperformance compared to other country, then further going to industry, then taking a company analysis, then other valuation stuff into consideration. And while talking about bottom approach, we usually ignore what are the things which are happening in the macroeconomic factors, and we try to focus on a specific company. Like it can be a case a company is doing very well, whether the industry is doing really bad at times. This is just a pyramid to try how we should start a valuation investment approach. Like if we are going with a top-down approach, we'll start taking things from a broader perspective, like things into global scenario, political factors, then IIP, GDP, then understanding the industry structure, then further stock selection, understanding the business, financial statements, and ratio analysis. Once we are pretty much satisfied that the global economic is very good and our country is very doing very good, we try to find which industry is attractive. One can find what are the how the industry is attractive by looking at a government policy and keeping update on it, or one can use something called as Michael Porter five forces. What it tries to tell you how the industry is attractive in the long run. It really doesn't take into the effect of short-run factors like demand and supply and technology. It tries to tell how the industry would be profitable in the long run. First point would be threat of new entrants. Like, for example, in India's case, India's oil and gas industry requires a huge capex, and it's really difficult for a common investor to enter into such kind of business just because it needs use of huge capacities, huge capex, and huge government policy. So, if you're already in this industry, you really don't have any kind of threats because it's very difficult for any new entrants to come in the industry. Next would be threat of substitutes. What are the products the company is offering? Is there any substitute available in the market or not? If the substitute is available, I think it's a risk of concern for the industry because anytime the buyer can switch on to the other product from other industry. Talking about bargaining power of customers, like if the company and the industry is highly dependent on only on one buyer for its revenue, so it's very risky. One should try to avoid it and try to build up a strong base of customers which focuses on a wide range of customers and not depend on one customer. Bargaining power suppliers tries to tell about the raw material what the industry is using. Like if the industry is highly dependent on one raw material, so it can lead to a cause of concern. For the example of crude in the and taking the example of airline industry, the only thing they use is a raw material, it's crude. So if the prices of crude rises, the airline industry gets affected very early. And competitive rivalry tries to tell us whether the industry having a rivalry or not between each other, like whether they're competing on each other with price or they are trying to offering different products. If the industry just try to just focusing on the pricing of the product, so I think there will be the industry is very competitive, and it's really not a good bet to invest in such companies because they are least focused on the invention and innovation and research. Once we have understood the industry structure and realize the industry is very good for investment, we can just list down the stock and just find out which are the best company would be benefited if the industry does well. And moving down, understanding the business of the company, like taking things into consideration like revenue. Talking about revenue, we would like to understand how the company is generating revenue, which are the different segments the company is dependent on, and what are the products they are offering on, like how vast the product range is comparing to its peers, and understanding the customer base, like as I explained to you earlier, like whether the company is dependent on one customer or they are relying on different sets of customer. And we have to also understand the business plan. What are the business plan of the company in future, like whether do they have any capital expenditure plan or expansion plan, or they have planned any kind of merger and acquisition with any competitor. And lastly, the understanding management, how good the management is and how well the management has the experience in this business. So these all things affect company, not one thing. These all things are very much important in the company. We are investing into a stock. We are not just determined upon the price of the company. We are also determined how the business is panned out, and how the business would pan out be in future. Next would be, I think, the most important thing in fundamental analysis, where the number crunching comes in. Understanding about the income statement, which tells you about the financial performance of the company. Talking about the balance sheet, which tries to tell us about the health of the company, and cash flow statement, which just try to keeps a cross check whether the in which section of the company there is a cash inflow or outflow. First, we try to understand the income statement. Talking about sales, like we should always try to figure out a company which has grown consistently in the past. A company has given good result, one is really not a good investment. One should try to find out such companies which have consistently done well in the past, and what are the raw materials they have used, like how much percentage of the costing is dependent on raw material, whether there is any kind of substitute in raw materials or not. Talking about operating income, the income which is given by company's main business. What I mean is, like, we are least bothered whether the company is selling its land or receiving its dividend from any investment in associates. What are the company's operating income from its main business we should be focused upon. And talking about interest expense, whether the company is taking additional debt and it's payable and it's paying its interest time or not. And talking about tax, how much the company pays tax on a regular basis, and what are the tax rate of the company. And finally, called as PAT, profit after tax, also known as EPS. This is the most important thing we are concerned about. We usually discuss about EPS because EPS tries to tell us about the earnings per share, how much earnings per share does the investor get? I've just given you an example of Bharat Forge last 4 quarter results, and if you can see over here, I think the company has done very good consistently in the past, and I think the price which have recently rose, I think is fairly justified, as you can see. And also in terms of sales, the company's sales have increased year on year also, and quarter on quarter also. Next would be understanding the balance sheet. We really won't talk about how the balance sheet value comes into place. We will just try to focus upon few things, like while making an investment decision we should be concerned upon, like increasing loan. If a just company just increasing its loan and its interest expense is increasing, and the company doesn't have the capacity to pay the debt back, so I think it's a cause of concern to the investor. So one should really avoid such companies. And talking about accounts receivables, like the company just making its sales, or the company is also receiving its cash from sales or not. If the company's accounts receivables are increasing on the continuous basis, it means the company is just making the sales and not receiving the cash. There's a less cash inflow, so it can be a concern for the company. And talking about inventory turnover, like how quickly the company is selling its inventory, like if the company is not able to sell its inventory too quickly, so the inventory would come outdated, and it will face difficulty in selling its inventory in recent times. So a company selling its inventory at a far good pace comparing to its peers, I think it's a really good thing. Talking about cash, like how much cash does a balance sheet have in the company, and what are the future growth plans? If the company has any growth plan in the future and the company has a huge cash on its balance sheet, so it's a good sign, because the company can anytime utilize the cash and just plan its expenditure. They don't really have to rely on the debt or issuing new equity. And talking about assets, like this is a main concern in usually in IT industry, because IT industry hardly have any kind of tangible assets. So it is a quite of concern, because it would be really difficult to value such companies, because we're trying to value an intangible assets in IT companies. So we should keep these things into mind. I've just given one more example, McNally Bharat. From last 4 years, the company was consistently rising its debt. If you have a look at this figure, and you can also see the company's price hasn't went anywhere. The company's price has still underperformed the market in the last few years. So just, I think if you have just looked the debt of the company, it could have easily signal a red flag for you, and give you a signal one should avoid such kind of companies. Moving on to the cash flow statement is divided into three parts: operating cash flows, financing, and investing. Operating cash flow tries to tell us the inflow and outflow of the cash from the business, main business of the company, like whether the company is paying its payable, receivables, and invest inventories. If they are buying a inventory, there is a cash outflow. When the company is receiving cash, there is a cash inflow. So we can just keep a cross check on the balance sheet in the income statement to cash flows. And talking about financing, it's like whether the company is issuing debt or raising debt, where whether the company is paying back its debt. So one can just keep a check on it through cash flow statement. And talking about investing, has the company built up a new plant or any new facility or any expansion project, you can just keep a check on capital expenditure of company through cash flow from investing. Next would be understanding ratio analysis. There are many ratios, but I think these are the few important ratio must one must really be take care of while investing. As we discussed earlier, operating margin, like how efficient is the company in its operating business. I've once again taken the example of Bharat Forge. You can see from the last few quarters, the company's operating margin have increased. What it means, the company have consistently made efforts to reduce its cost. What it tries to tell us. Talking about gross profit margin, it tries to tell us about the raw materials the company is using, whether the company's raw material use as a cost is in reducing or not. And talking about profit margin, it takes into consideration about the bottom line of the company and the top line of the company. It takes how efficient the company is in overall format. Talking about some important ratios like ROCE is return on capital employed. It tells you how much percentage of return the company has it's given to both equity holder and debt holder. And return on equity just try to tell us how much return the company has given to its equity holder. So there are no definite number for any kind of ratios. We have to just compare it with another companies and with the industry. That would be the best case. Talking about turnover ratios, as we have discussed earlier, inventory turnover, a good company is like who is selling its inventory at a good pace, and asset turnover, how the company is utilizing its asset. Talking about interest coverage ratio is like how much capable the company is in paying its interest. A interest coverage ratio more than one tells us okay, the company is very good enough and the company is capable of paying its interest. Whether it's taking an additional debt, the company is paying its interest very regularly and it has the potential of paying the interest. I've just added one more example for Castrol India. If you can see on the left hand side of the chart, there is a technical chart for crude. As the crude price was decreasing, the price of Castrol India was increasing. Just because Castrol India uses 65% of the raw materials as a crude. So the market has identified few months back only, and as the crude price was decreasing, the Castrol stock price was increasing. Next is an example of inventory turnover. These are the few sets of company which I have given you. If you can see these companies inventory turnover declined consistently, it means the company was really not able to sell its inventory, and that's why the company share price never rose. So these are the few things which can investor can make upon while making an investment decision. These ratios are quite easily available in few of the websites like Money Control, and if any one of the franchisee want to have any kind of ratio, we can just email it to them. They can just ask for the ratios which they want for a particular company, or any kind of ratios like balance sheet, income statement. We can just help with them. Once we have understand the balance sheet, we would like to understand the valuation of the company on a relative basis or an absolute basis. When we talk about relative basis, we really talk about the multiples which we use like PE, price to sales. And the main thing we have to keep in mind while relative valuation, like we're comparing the company with some other thing. What is the benchmark of the company? A stock P of 100 doesn't mean the company is bad. We have to identify whether the stock is undervalued or overvalued relative to its benchmark. So we have to keep in mind a relative valuation tries to value a company comparing to its other peers or benchmark. This is the most common multiples which we use, and I will just try to focus on price to earnings. We normally say a high P is a bad stock, but that's really not the reason. A PE stock takes many things into consideration apart from multiples. It also takes things like into consideration like growth of the company, risk in the company, and capital structure of the company. So a high PE can be a growth stock. We have to come with the proper reasoning why the company is trading with a high PE. If you have a look at these two chart of Eicher Motor and Bharat in Bajaj Auto, Eicher Motor was relating was quoting at a very high PE, but then also the stock has consistently outperformed. And other side, where Bajaj Auto was quoting at very low PE comparing to its peer, then also the stock has never performed. So one has to look for the reasons why the company, one has to look for the reasons why the PE is high. In valuation perspective, we always have to use the forward P. What would be the forward P of the company? Not the current P or what a P it occurred in the past for valuation. So these are the things we have to keep in mind. And talking about price to book value is like if the company has paid all its debt, what is the amount each shareholder will receive? Usually price to book value are used in an industry usually where there are industry like banks where they hold liquid asset into the books, and it's really, and if you're trying to value a IT company account to price to book, I think that's really not a good sign. One should try to use the relative valuation method according to the industry. Talking about absolute valuation, we would really won't spend much time over here because it is done by experts and most of the valuation is done computerized. We will just try to tell you that free cash flow to the firm tries to tell us what is the cash flow that equity holder and debt holder will get, and how much free cash flow the company is generating per share. And dividend discount model, it tries to project the dividend of the company in the future and discount it back. Some of the investors also rely on dividend payout or the ratio of the company. It's really important to understand a dividend paying company, what are the growth prospect in the company and what are the opportunities of the company. For example, a company paying high dividend, it really doesn't mean the company is good. It can be the reason the company doesn't have any kind of future growth prospect in the company. So one has to look out for a reason. If the company just paying, this company is paying a regular dividend and suddenly the company just cuts the dividend, so it can be a cause of concern and give a negative signal to the investor. If you're looking for a company which is giving a healthy dividend, I think we should make a history of the dividend which the company has paid. These are the few sets of company which have consistently paid a good dividend from the last few years and they have done quite well. And talking about lastly, understanding the quality of financial reporting is like whether the company it's reporting its number are real or not. When I talk about financial reporting quality, whether the company is reliant, whether the company is making full and fair disclosure about the earnings or not. So this can help us in valuing the company. And talking about high quality earnings, like as I told you earlier, we should be focused upon the earnings which can occur on a continuous basis, which we should really avoid. We should really avoid like land sale, a divestiture. We should really avoid such kind of things while valuation because these things would really won't occur in the future. And talking about accruals, earnings, cash basis, like as I explained to you earlier, like if the company is just making its sales and its receivables are increasing, so it's a concern for the company. If the company is making the sale and side by side it's receiving its cash from the customer, that's a good sign. And understanding about a parent subsidiary relation, it's like if the company has make an investment in another subsidiary, so we should try to find out what are the subsidiaries business into, or whether the subsidiary is into completely different business. While taking an investment decision, we should try to find out whether the company has overpaid its subsidiary and what is the goodwill of the company. For I think for investment purpose, I think we should try to use the standalone business apart from consolidated, because there are companies which are engaged have many subsidiaries and would be really difficult for a common investor to come into an investment decision with relative to the many subsidiaries. This is one more example of a company called Bharat Bijli. If you have a look at the market cap of the company, it's nearly about 300 crores. And if you go into the detail of balance sheet of the company, you can find out the company has an investment in HDFC, Siemens, and other shares, which comes to a value of 360 crores. But if you have a look at the company's operating business, the company has never was struggling to make profits. So it doesn't matter how healthy is the balance sheet. We have to look upon how the companies focus on the main business. If you also you can see the price chart, the company hasn't performed very well in the past. So these are the things we can just try to focus for a common investor while making an investment decision. I would like to end this webinar just telling you few things and every investor or every dealer should keep in mind. We should use the most of social media. I think one should really read newspapers, try to keep themselves updated about the news for a particular stock, and try to avoid rumors and messages and research reports. I think one should really make most of it, just because they are prepared by professional and it takes a lot of hard works. So I think one should really make use of it, and taking a perspective from a portfolio, like when you are making an investment decision, you should always make a decision through a portfolio perspective. No matter how the stock is, one should really not invest more than 7 to 8% of the total portfolio in a particular stock, and avoid trading on non-public information, like avoid trading on rumors just for the sake of efficiency of the market, because it's really not a good thing, because it can come at a cost from the small investor, and sometimes it can lead to a erosion of the value. These are the few reports which we publish on a regular basis. This is the page one, like every morning we just try to keep you updated about the latest happening about the market, so one can really check to it and keep them oneself updated. This is market rank, like it tries to tell you which sector is outperforming in the 30, 60 and 90 days in the recent times. This is a report for commodities, just to signal about the commodity prices. And the lastly would be week ahead, which tries to give you a detail about what are the upcoming events in the week, which also tells about any important results about a company and any foreign events. So I would end this webinar just by saying, do not wait until disaster strikes before learning the way how to analyze a stock, the true value of a stock.